This week, we're going to be talking to the Canadian head of a company that manages $400 billion US globally. And we're going to be talking about how we can understand to make better wealth decisions based on factors and the way the industry is moving and things that you need to think about as an investor. So stick around because you're going to learn a few things.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Johnathan Needham. He is the president of Russell Investments Canada Limited, and Russell manages approximately $400 billion US globally. He's also a member of Russell's Global Operating Committee, and he serves as a trustee on the board of directors. His focus is on positioning the firm for long-term growth in Canada. Johnathan, how are you today?
I'm wonderful, John, and thanks for inviting me here. Greatly appreciate it.
It's my pleasure. Because Russell doesn't have a big footprint in Canada, it's more of a global firm that has a small footprint in Canada. I think it would be best if you could maybe begin by just telling us who Russell is, what the firm is known for, and what it is you do.
Yeah, happy to, John. Thanks so much. I guess to summarize it, Russell, we've always been known as a manager of managers. So really bringing together the specialist managers and styles to build more resilient portfolios. As you mentioned, 400 billion US globally, 90 years in business, and 40 years here in the Canadian marketplace. But if I had to kind of nail down to what our special sauce is, it's really how we integrate manager research with portfolio construction, not really separate discussions.
Okay, good. So that's helpful because, a lot of what we talk about here is making better wealth decisions. And oftentimes the two things are seen as being silos. And, you've sort of integrated them as being one thing. So I'm wondering if you could maybe also expand a little bit more about Russell and its split between the institutional side and the retail side. How is that working out?
Yeah, thanks, Sean. As mentioned, 90 years. So I think that's where our heritage is really focused on the institutional client, but we've been serving the wealth advisor community now for over 40. So the split is almost equal. And in fact, even global assets today are almost equal. So the institutional and retail business are almost equally split. So kind of really interesting. What we've always done is brought that institutional mindset into retail and applying our manager research and portfolio construction expertise, consistency across the board. So it's not one or the other. Our role is to bring that discipline, the research, the portfolio construction and implementation to advisors and everyday clients, in addition to the institutional client.
And so what I think I'm hearing you say is that if you've got sound principles, that those principles are transferable, and it doesn't matter if you're a retail investor or an institutional investor, the ideas, the mindset, the thought process should be pretty much identical either way. The objectives are the same. You can tweak them a little bit based on, if you're a pension plan or something like that with an indeterminate time horizon. But in general, the principles are the same. Is that fair?
Yeah, I think it's fair. I think, listen, we're here to solve problems for clients, right? Whether they're a sophisticated institutional, sophisticated retail, or a typical kind of mom and pop shop. And I think, the same kind of challenges both clients have as investors in terms of navigating the market and building sound portfolios that are going to stand the test of time. I think probably the only nuance on the individual side is they're a little bit more tax aware. And so more personalization around taxes. But other than that, you're absolutely right. Treat them the same.
So in the US, there's a strong demand for more personalized portfolio solutions. And is there anything like that going on in Canada? And if not, maybe it's coming on the horizon. What are your views on that?
Yeah, the short answer is yes, particularly as clients' wealth grows and as taxes seem to take more away from that growth. So personalization and tax minimization is key. I think, direct indexing is something that's really kind of shining the light on that. And the growth of that in the US in particular is profound. In fact, it's one of our fastest growing businesses on the retail side in the US. Now, it's not quite here yet in Canada to the degree that it is in the US, but no doubt and no surprise, I think it will be coming.
So let's see if you can polish up your crystal ball. Talk a little bit about direct indexing in terms of what it might mean for Canada. Hey, could you just explain what it is and then maybe offer a best guess timeline for when we might see it becoming a common practice here in Canada?
Yeah, so we're seeing it kind of a little bit, it kind of sprinkled in the market. And I think as firms and technology becomes more prevalent and call it tech stack becomes more like they have south of the border, you'll see more of it in the Canadian marketplace. And so really what is direct indexing? I mean, quite simply, let's take a Canadian S&P TSX 60 or the S&P 500. Instead of owning an ETF that tracks the index, you own all the underlying securities. And you actually get to decide if there's any of those securities you may not want to own. And so you can screen out things more personalized to yourself. And then really where the advantage is on the direct indexing side is it's personalized to you and harvesting taxes or gains and losses along the way. So essentially it's providing tax alpha. So in Canada, Russell's built kind of the tax overlay, and you're looking at 50 to 100 basis points of additional alpha within non-registered accounts, so value, if you will. And so the ability to kind of own what you want to own, sure, you're going to pay a fee, probably similar, slightly above what it would be equivalent to buying the index ETF. But now you're actually getting better value from a tax minimization perspective.
And I'm wondering about reconstitution risk. One of the things that people say sometimes about the risk of being in an index is that a stock will be announced that it's going in or coming out of an index 5-6 weeks before it actually happens. And generally the ones that are coming out drop in value and the ones that are going in go up in value. And if you're a direct indexer, presumably you don't have to wait because tracking error is a real thing. And the people who actually manufacture products that track a benchmark buy and sell those securities on the day that they are put in or taken out of the benchmark. Meanwhile, you know in advance what's going to be going in, what's going to be coming out. So there is an opportunity to hopefully enhance your risk-adjusted returns by being a little bit fast and loose with regard to tracking error. Are people doing that as well?
They are 100%. And I think that's when we look at it is what is their tolerance for that tracking error, and right. To the degree of that tolerance is going to determine how personalized you can get. And that's a perfect example, John. You can 100% plan for that.
Okay, let's talk about product development. How does Russell look at product development globally? And are there any unique attributes, differences that are things that are maybe unique to Canada that we might do things differently the way you build products here as compared to the jurisdictions?
Yeah, I think holistically, for sure. I mean, 100%, you always got to look at Canadians as individualized and obviously relative to south of the border, there's going to be some home bias. Invest a little bit more in Canadian equities and Canadian bonds than we are going to outside of our borders, albeit that has certainly been less prevalent over the years. And I think the other thing to think about from a product perspective, I mean, particularly when it comes to ETFs, and that's where we're seeing that the fastest growth, both in the institutional and retail side, is the ETF industry has been very product driven. But from my perspective and Russell's perspective, clients think in terms of portfolios and outcomes. And so this is where really kind of Russell's positioning its business is, as we build out our offerings, in particular ETFs, is to ensure that we're thinking holistically so that we can create better outcomes for clients. And so I would say the difference being clients in the US are looking for solutions and models. In Canada, they're looking for building blocks that work well together. And they're more outcome oriented. And so I think simplicity on the surface, sophistication underneath, that's really our focus when we look at building up products.
Yeah. So let's talk a little bit about a more customized portfolio solution. When you look at your ETFs here in Canada, the suite of products that are offered by Russell, would you say that there are things that you're doing that allow for greater degrees of personalization? And if so, what would they be?
Yeah, 100%. I think, a couple of things that we've seen in the marketplace, and particularly, and I know, John, you're an evidence-based investor, so you believe, that there's a certain amount of evidence to suggest that owning an index and or owning some factors are going to allow a client to achieve better risk-adjusted returns over time. And so I think, Russell is known as a multi-manager and pairing best-in-class managers together. And in particular, we're doing that in our ETF solutions for active managers. So active fixed income in particular, where we know we can add value consistently over time relative to benchmarks. And then where it's more difficult to outperform benchmarks, broad markets, as you know. And so that's where we think that building multi-factor strategies to take advantage of, growth, value, momentum, liquidity factors that persist over time, combining them together will give clients better outcomes and at a low cost. And so I think, one of the things that maybe not be known about Russell, because we're known as a multi-manager, is we actually have a lot of credibility in the factor space. We built a pedigree in factors for 40 years, not just on the institutional side, but also in the retail. And so we brought multi-factor solutions to the Canadian marketplace to help clients achieve better risk-adjusted returns with transparency and low cost.
For some of the people here, some people have heard about factors a fair bit, and I'm wondering if it might not be useful for you to take a moment to maybe say a few words about what some of the major factors are and why they can get those better risk-adjusted returns that you were talking about a moment ago.
Yeah. So, you probably heard of some of them over the years, right? You have momentum. The trend is your friend, right? And so stocks that are going up tend to go up for quite a period of time. And so, if you can get exposure to that factor, you will outperform the market over time. Value is another one. Buy cheap stocks, buy stocks that are on sale, and over time, you will outperform the market. Now, liquidity. So buy less liquid stocks tend to have a liquidity premium, and you can outperform over time. Growth stocks are another example. Size, small and mid cap, right? If you're buying small mid cap over time, you outperform. And so I think the key is combining those factors together, and also, timing the factors, is that's very difficult, but getting the appropriate factor mix will allow you to track an index fairly closely, but provide additional value. And it's really with the lens of risk. And so I think that's one of the challenges that Canadians have today in the marketplace is, from what I can see anyway, a lot of the trends of what they're consuming is highly concentrated thematic ETFs and thematic strategies. And those can certainly work for a period of time, but they can also work, right? And so I think, I look at discipline. And so if you can essentially capture factor returns that persist over time and mix them together and do it in a low cost way, you're going to get better risk adjusted returns without a wild ride. You're not going to suffer from indigestion along the way.
Good. Now, as you mentioned, we've known each other for quite some time, actually, going back to when you were at another shop. And prior to joining Russell, you spent 13 years, something like that, at another ETF shop and preparing for, the industry and helping oversee the rapid growth of the ETF industry in Canada. Do you see that continuing, or we've already talked about, other ways of slicing and dicing things, or are there other trends that you're seeing right now that you think might supersede ETFs?
Yeah. I mean, I think so. The trend is your friend again, right? I think, John, what we're seeing is, investors of all types have really embraced the ETF structure, right? Being able to buy a solution that's catered to you, that trades on the exchange in real time with transparency, liquidity, and low cost. And so I see that continuing is the short answer. I mean, the market backdrop today, I think it's over 800 billion in exchange traded funds in Canada. That's like a 23% annualized growth rate. And so, I think, maybe it'll slow at some point in time. That's pretty significant growth. But I see that continuing. And I think you're going to see kind of enhancement. I think investors initially were buying passive ETFs. So ETFs that track a broad market index, and then factor strategies, whether it's dividend growth, value, or multi-factor. And now we're seeing clients buy more active solutions, whether that's a multi-manager like Russell brings to the table, or single ticket solutions like the asset allocation ETFs that have just grown immensely and providing great value for an investor. And so I personally think that trend will continue. And I think it will continue for quite some time.
Okay. All right. So we're at the end here, and it's gone by just like that. Like I knew it would. The podcast is called Make Better Wealth Decisions. And I'm going to give you lots of time here, and I'm going to give you a wide open canvas, and I'll let you take as much time as you want. If it's up to you, Johnathan Needham, what advice would you give to listeners of this podcast to help them make better wealth decisions?
Yeah, that's a great one, John. I like that. I think, listen, we've been in the business long enough to know that you build a plan, you stick with it. You manage your portfolio, or you better yet have somebody who is a professionally licensed advisor to manage your portfolio on your behalf, who lives and breathes the markets all day long, in order to protect you from yourself is the reality, right? There's a lot of behavioral biases and challenges that happen when it comes to investing in the market. And so, simple advice, have a plan, stick to it, consistently add to your portfolio, Dollar cost averaging certainly helps over the years. And don't make any emotional rash decisions. Stay diversified, stay globally, with a global mindset, and you will thank me 10, 20, 30 years down the road.
Exactly. All right. I like it. That's sound advice. And it's the sort of thing that, that I say a lot and that a lot of my other guests say a lot. So you're in good company when you say that. I want to thank you for your time today, Johnathan. It's been a real pleasure.
Well, thanks, John. I appreciate it. Thanks all your listeners for tuning in. Greatly appreciate it.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.